screen, right?
Yes, yes.
Perfect. So as I mentioned a few minutes ago, today's topic is trying to cover the wealth and asset allocation during 2024 second quarter. And we will try to focus on the different markets and different asset style and how they manage their allocation. Because please try to understand first the basic topics. Let's say the Dr. Walchin has $1 million and he is not sure that which type of investment he wanna do and how he distributed this $1 million among the assets. So let's say he's a risk averse person and he wanna be ensured that he will not lose lots of money in the turmoil times in financial market. And he's putting, let's say, in fixed income 30% and the cash in 20%, in stock exchange in 25% and 25% in hybrid assets. So we will try to understand how this distribution and allocation among the assets can be done and what is the basic logic behind those type of allocation. We will try to understand those basic concepts today. And here, first of all, please look at this G3 financial condition. Here we have on the left-hand side a basic shape and a graph. It is showing the United States and Eurozone financial conditions. So what we mean by here, the financial condition, how the liquidity and the financial market is emerging and evolving in the United States and Eurozone between 2007 and until today, approximately, let's say, 16 years. So here, as you see, on the x-axis, we have some values. Those are indexes. And here, as you see, two lines, the purple or light blue line is the United States and black line is the Eurozone. And what we mean by here, the tighter condition in the financial condition, the tighter one is high interest rate, a stronger currency, lower equity valuation, and wider credit spread. Or the vice versa, the loser one, the decrease in the interest rate, and some depreciation in the currency, and we have huge gain in the equity because equity valuation is not lower. We are earning lots of money in the financial market. Not a wider credit spread, but it is tighter credit spread because there is huge liquidity in the market. If you have low liquidity in the market, the credit spread is widening. So the borrowing and the giving credit to financial market spread line is really, really high in the financial market on these days. So let me explain the basic condition behind those spreads and the financial market situation. It is this. Let's say you are in a financial condition like the tighter one. There's a high interest rate in financial market. So what is happening if the interest rate increasing? If the interest rate increasing, first, I will borrow from the financial market with a higher cost. Second, because the interest rate increasing, it is increasing the risk-free interest rate as well, like the 10-year treasury bond, or let's say 30-year treasury bond. And as you know, the induced form, how can we say, the cash flow induced form of the valuation like this. Let me do this one. Give me 1 second, please. I will share a black screen, something like this. Can everybody see my black page or white page?
Yes.
Perfect. The value of the asset here. Please don't move your mouse on the screen. Please don't move your mouse on the screen because you are drawing the line. Ladies and gentlemen, please don't move your mouse on the screen.
Let me repeat that for everybody. Dr. Dogan is asking us not to use our mice on the screen at this time because this is causing interference. Whoever is using a mouse at this time, you can see every time you do that, there is a response, an electronic response of the system on the screen that is a problem. So please kindly refrain from using your mice at this moment.
Okay, thanks, Dr. Walchin, for your contribution. Here, please try to look at this equation. This equation showing a value of an asset. And this is the lifetime cash flow of that asset. This I is interest rate. These are the cash flow for term 1, term 2, term 3, and until term M. And here, as I said, the I is the interest rate, and M is the term, today, next year, or another year. Please say me, if this interest rate increasing, if the interest rate increase, what will happen this number? Decrease, right? If the interest rate increase, the denominator increase and the value is decreasing. This one is decrease as well. So the value of the asset decrease. What does this mean? If the financial market condition, let me close this one. And now let me share my screen again. I'm here and I'm saying the higher interest rate. If the interest rate is higher, this is directly can be assumed that lower equity valuation, because the prices of the equity will be lower because of the increase in the interest rate in the financial market. You can directly understand that if the interest rate increasing, nobody will borrow, nobody will buy the equity from the market, and the price of the equity will decrease in the long run. Okay, so if the Dr. Walchin has an ability to borrow the money from the bank with the lower cost, lower interest rate, and if you see the condition in the financial market is good, Dr. Walchin will go to the bank and apply for a $1 million loan. And with that loan, Dr. Walchin put that money into the equity. So if everybody borrow, the price of the equity in the market will increase because everybody will buy it. But what is the initial point? Everybody borrow that money from the bank with the lower interest rate. But if the interest rate is increasing, nobody will borrow and nobody will buy the equity or any type of asset from the financial market, and the prices will go down. Okay, so as you see here, if the monetary policy or financial condition is tight, this means that there is higher interest rate in there, a stronger currency, no depreciation, lower equity valuation, and wider credit spread, and the vice versa. And what happened during these 16 years in the United States and the Eurozone? Here, as you see, here what happened? Here we had the COVID-19 crisis, right? And after, please look at here. Here we have global financial crisis. After the global financial crisis, as you see, the tighter financial condition here. After the COVID, another tighter financial condition. What is the reason behind those tightening in the financial condition? Because the interest rate increasing. Why? During the COVID crisis, there is no demand in the market. There is no consumption. There is no investment. And all the central banks decrease the interest rate during the crisis. COVID, global financial crisis, any type of crisis. During those type of crises, the central bank decreasing the interest rate. And then the inflation start to increase. So what is the response of the central bank for the increase in the inflation? They are increasing the interest rate. And then the financial condition becomes tight. Okay, the basic logic is billowing like this. And here, what is happening in another world, is another continent, the Japan example. This is really important for us because the turmoil in the financial market in August start with the triggering point in the Japan financial condition. Please look at this. Until today, from 2011, approximately 12 years, the financial condition is loosening in the Japan, meaning that interest rate is decreasing, not tighter, it is looser. So interest rate is decreasing. Depreciation in the Japanese yen and a huge valuation in the equity and a really, really tighter credit spread because there is huge liquidity in the market. So what happened here in the 2024? Financial condition becomes like this. It is tightening in the Japanese market. Why? Because there is an inflation in Japan and the Central Bank of Japan, the Bank of Japan, start to increase the interest rate from 0.10 to 0.25. Now, when you understand what is happening and when the market is tightened and loosening in financial condition, now we can pass to the next slide. It is the global equities return composition. What we mean by return composition? Let's say we have an Apple stock. Okay, Dr. Walchin today buy an Apple stock. Let's say approximately $500,000. Cool money is in the Apple stock. And let's say 2 years later, Dr. Walchin earned $300,000, meaning that the total money will reach the 800,000. But Dr. Walchin wondering that where this 300,000 comes from. Is it just the price changes in the Apple stock? Or is it the dividend that I take until today? Or is it the currency changes because of the stock exchange? So I want to understand what is my income, profit coming from? What is the composition of it? So if you look at these 5 different markets, here as you see, United States, Japan, Europe, emerging market, and Asia Pacific, but excluding with Japan. So when I say the Asia Pacific excluding Japan, even Australia, Hong Kong, China, Thailand, Philippines, Malaysia, Indonesia, all is included. Just the Japan is excluded, APAC region. Okay. And this black bar showing the multiple expansion. The green line showing the earning per growth. Give me 1 second, please. I will change the screenshot there because as you understand here, the basic dimension from the United States and Japan and Europe and emerging market, then Asia Pacific excluding the Japan, this means that this black bar is the multiple expansion and this green bar is EPS growth output, meaning earning per share. And if we speak about the dividend yield, this is the blue line there. And then the currency return is the purple one. And the total return is the just rectangle in orange. So, sorry for this. The seasonal changes in Turkey. For that reason, it is just a flu. Sorry for this. And now, please look at the line here. This is 2023, and this is 2024 year-to-date return, total return, and we are trying to understand the composition of it. What is the total return in the United States? Approximately 26%. But what is the most
composition coming from? Approximately 15%. Where does it come from? Multiple expansion. Only just, as you see, 6% is coming from the earning per share, and just around 2-3% is coming from the dividend yield. For instance, in Japan, approximately -8% coming from the currency return. Why? Because Japanese yen is depreciating against United States dollar. And here, as you see, the total return in the Japan is around 20%. And where is the lowest? The lowest one is Asia Pacific, excluding Japan, is just 7%. But as you see the euro, please look at the euro. Currency approximately brings 6% for the contribution of the total return. Why? Because the euro USD parity increasing from 1 to 111. So approximately 6% coming from the currency valuation. And if you look at what is happening in the 2024, the picture is changing. First, around 20% total return, we have just 15 or 10%. Total return is decreasing all around the world, not just in the APAC region, not just in the United States, all around the world. The currency composition is started decreasing because of those type of valuation. And the secondly, if we start to understand what is happening there in the 2024 year-to-date return, total return concept, we can directly understand in the Japan, approximately 15% is coming from the currency depreciation. And in the United States, most of the contribution in the total return is coming from the multiple expansion, and the half of it coming from the EPS growth, as you see. And lastly, if you look at emerging market or Asia Pacific, normally has a lower return compared to the United States or the Europe or Japan. But now they are almost equal. What we mean by this, as the market condition is tightening and as the credit spread increasing in the Asia Pacific side or emerging market, this can be directly interpreted as that the capital flow starting from the United States or Europe flowing to the emerging market or Asia Pacific side. And now, please look at the slide. We are now trying to understand the global equities earning expectation. The expectation is everything in the financial market. Why? Because we have a saying in financial market that buy the expectation, sell the realization. So if the price is increasing, it is not just the realization. It is mostly coming from the expectation in the financial market. So if I am directly saying that if the global equities earning expectation is evolving in the United States, again, we have 5 regions. And those are United States, Europe, Japan, Asia Pacific, and the emerging market. And here, as you see, please look at the black and the green line, the light green line. This is 2024 and 2025. These are the earning expectation for the 2024 and the next year. Please look at the screen here. What you can directly see and different pages in United States or emerging market. In the 2024, when we compare 2 years, United States earning expectation is increasing in the next year, in the Europe region as well. But in the Japan and the Asia Pacific region, the 2024 earning is higher than the 2025, meaning that lots of people has an expectation the overall earning in the company valuation and their net profit will decrease in the 2025, and they are, rather than to buy, to hold or sell the assets in the Japan and Asia Pacific. And the earning revision ratios. please look at the title here. What we mean by earning revision. It is directly assuming that net earning revision to consensus estimate 12-week moving average, meaning 3-month moving average values here. Again, the United States, Europe, Asia Pacific, and Japan. We are excluding here the emerging market valuation. And now, as you see, what is the lowest one? Earning revision. Here, as you see, the lowest one is again the Asia Pacific. It is excluding with Japan. And the most dramatic pages is here, this one. All the earning revision ratios is decreasing and just around between 0 and 20%. Normally, after the COVID process, even it is increasing to 60%. This is earning revision, huge earning after the COVID recovery. But today, the market is balanced. The earning is around just between 0.20%. And now, the most important topic, I think, in the this presentation and the slides, it is directly covering the valuation. Valuation is everything in the financial market. If your valuation is lower than the today's market prices, and if the next couple of years expectation is lower than the today's book ratio or value ratio, this means that you don't have a logical reason to buy those type of assets. So if we understand those type of valuation can increase in the financial market, we can directly assume that equity market valuation, this is price to earning ratio. Okay, please try to remember the previous slide in our session. I directly represent and reflect those type of slides in the financial market and different type of valuation. One of them is price earning ratio, one of them is price to book ratio, one of them is dividend yield, and one of them is earning per share. Those type of different slides I share with you in the previous session, and you will understand that what is the price earning ratio and what is the price book ratio. But if for those some cannot remember what's happening in the price earning ratio or price to book ratio, let me repeat it. Price to earning ratio meaning that today you have a price, but the earning is an estimation for the next year or the next couple of years. So if the price earning ratio is decreasing, meaning that my company is cheaper. But if the price earning ratio is increasing, my company is absolutely expensive in the financial market. And please look at this different region in the financial market and try to understand the price earning ratio in which market is hugely high compared to the other region in the world. So please look at, by the way, this black line showing the black bar showing the 15 years average, 15 years range, and the blue line showing the 15-year average, and the dots in the green line showing the latest value in those assets. So if we can directly compare to S&P 500, Europe, Asia Pacific, emerging markets, China, Hong Kong, India, Indonesia, Japan, please look at the Japan example here. What does the story tell us? Normally during 15 years, as you see here, I have directly a good valuation normally in the latest range. But the 15 years range, as you see here, approximately from 10 to 30, meaning that price earning ratio even increased to the 30, hugely expensive market. Price is really high, earning is really low. And price earning ratio is increasing in this type of market. So what can we understand from this picture and which type of market I can put my money? Price earning band is lower and today price earning ratio is really lower. Which one of them is the lowest in the price earning ratio? Please look at China. China telling us a huge story about the valuation and their style of what type of opportunities we can get at the end of the year or next couple of years if we put our money in the Chinese market. Why? As you see, the Chinese market price earning valuation even increased to 20%, but now it is just 9, even less than the 15 years average. Please and please, ladies and gentlemen, if this green dot is above the blue line, meaning that the latest value is higher than the 15-year average, that country or that financial market is expensive. Please look at expensive, expensive, almost fair, almost fair, fair, cheaper, fair, cheaper, cheaper, Hong Kong, really cheaper. 15 years average is 15, and the today value is just 11. But absolutely expensive, India. Or let's say Taiwan, absolutely expensive. Or let's say Philippines, really, really cheaper. 15 years average here around 16, and the today value, latest value is approximately 11. And if I change this market valuation price to book ratio, not the price to earning, but the price to book ratio. What we mean by price to book ratio, let me remember those type of definition for those who cannot remember from our previous session. Price to book ratio is this. Let's say Dr. Walchin buying a company, and let's say the company has a book ratio from their factory, equipment, machinery, cars, let's say Apple, or let's say a company and factory in the San Francisco. If I sell all this factory, machine, equipment, all the fields on the factory build up, every human capital, if I sold, there is a value, and this is the book value. And the price is reflected in the financial market. It is independent from the book value. So if the price to book value is equal, that company is fair. If price is higher than the book, meaning that investor has a misconception about the real value of the company. Because if I sell everything for those companies, it is less than their prices. So if the price to book ratio is less than its average, the company is cheaper again. Expensive, expensive, because average is here and the latest value is here. So it is expensive. But what about the cheaper one? Cheap. China, cheap. Here, China, cheap. Hong Kong, cheap. But please look at India, expensive. By the way, all valuation style, we should approach each other. So if the price earning ratio is saying that company is expensive, price to book ratio cannot say it is cheaper. As you see, the same style for India. In both cases, it is expensive. Or China, in both cases, it is cheap. Okay, so if you have a money today, and if you want to make a long-term investment, not just for 1 month, not just for 1 year, but you are not sure that in which country, on which company you want to put those money. So the first answer is China, Philippines, and Singapore. But you couldn't put your money absolutely S&P 500 or let's say India. Those are absolutely expensive markets today with the valuation from different metrics. And now, please look at the developed market equities right now. What are those stories telling us? Growth versus value. What we mean by growth versus value of the company. Let's say Dr. Walchin wanna put that 1 million another style. He wanna put this company either in a startup or it is a really valuable company like Microsoft, Apple, Amazon. Or let's say Dr. Walchin get a recommendation from his friend, and his friend is saying that there is a new startup in California. They are getting lots of investment from different parts of the world, but it's a risk asset because it has just started its operation 2 years ago and nobody knows about it. So this type of company has huge opportunity to grow. But Apple is not. Amazon is not. Because they are value company. They are not growth company. Okay? They have a value in the market. They prove their value itself in the company, stock exchange prices, and investment and operation. But this growth, meaning that the company is just 2-3 years history, and it is just starting operation, and it has a huge growth opportunity. And please look at this chart on the left-hand side. Growth versus value. Growth expensive relative to value, as you see here, or growth cheap relative to value. Here, as you see that, lots of people today, all around the world, buying growth investment rather than the value investment, because they believe that, like the cryptocurrency, there are lots of opportunity and there are lots of chance in the financial market to bring additional money for their investment. And today, growth is really expensive relative to value, because lots of people buy the growth and its price is really high, expensive. Okay, so if you want to put your money, you should choose the value company, because growth company are today is expensive. And secondly, let's focus on the Morgan Stanley Composite Index in the correlation of the world, MSCI World Index. This is correlation of MSCI World sectors to 10-year US Treasury yield. And here, as you see, we have lots of different sectors. Ladies and gentlemen, first, while you are putting your money, you have some to-do list. The first list is this. In which country I should put money? Second, in which sector I should put my money? Third, in that sector, in which company I should put my money? So investment has a huge cost if you don't make your to-do list correct. You can put your $1 million and 1 month later, you can lose 30% of it in only 1 month. Okay, if you are not careful and make a to-do list and make valuation about your investment. For that reason, first, I should choose the country. Second, I should choose the sector. Third, I should choose the company in that sector. Okay, as you see here, we have communication, information, consumer staple, healthcare, utilities, consumer discretion, real estate, industrial materials, financials, value index, and energy. As you see, sector styles tending to outperform MSCI World when the yields are falling. And sector styles tend to underperform when the yields are falling. So please look at this picture and try to make an estimation about your next investment. In the next couple of months, what will happen to the yields and interest rate in the United States? Fed will cut the interest rate, right? In the September meeting. The old is 25 basis points or 50 basis points. Today, trader is expecting 50 basis points. The market average is 25 basis points. But in any case, we know that interest rate decreasing, right? So if the yields are falling, meaning that interest rate is decreasing, which sectors can make an outperform in the equity valuation? Please look at this. Communication, information, consumer staple, healthcare, and utilities. So when the interest rate is decreasing, don't put your money in the energy or financial or materials. Is this point clear? This is really, really important. If you know what will happen to the interest rate in the next couple of weeks, months, or years, you should understand that which sectors will bring the money for you. Communication, information technology, consumer staple, healthcare, and utilities. So now I decided first which country. China, then Singapore, then Philippines, then China. Okay, and maybe ASEAN country as well. So now in those countries, I will choose these sectors: communication, information technology, consumer staple, healthcare, and utilities. Then, now, if we focus on the United States, now the sector earning and valuation in the United States, if we focus on those pictures, what can we understand directly from those type of valuation in that sectors? Please look at the picture. The United States sector earning and valuation. It is S&P 500 earning growth estimate. As you see here, I have lots of different sectors: real estate, consumer staple, like a similar page here, energy, financial, consumer, communication services, consumer discretionary, industrial, etc. And here, what it's saying that earning per share changes. In which sector earning per share is changing perfectly? Communication services, right? So I will choose my per share earning is best in technology, healthcare, or communication services. So if I have a long-term valuation, don't put your money in the real estate sector. There is no earning per share growth in that sector. Okay. And here, as you see, the price to book ratio in the different sectors. Please look at the price to book ratio. What we say, if the price to book ratio is higher, it means that that sector is expensive, that company is expensive. Or if the price to earning ratio is higher than its average, again, it is expensive. Look at this here. Expensive, 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 expensive. Only which one is cheaper? The real estate. Why? And the energy. Why? Because energy prices is going down after the decrease in the oil prices, and the real estate is really, really lower because of increase in the interest rate in the financial market. And now, cash and capital expenditure. Why this is important? If I am putting the money in a company, I wanna be sure that that company have some cash for any type of prudential reason, any type of turmoil, any type of risk in the market, right? If there is no cash in the bank or pocket in that company, meaning that if there is a risk, if there is an unexpected condition in the financial market, we will be in a huge volatility of the prices of the company in financial market. And here, as you see, again, the huge cash in the communication services and technology. Please look at these two sectors. There is huge cash in these companies. And research and development and capital expenditure by sector, meaning that which type of capital expenditure they are doing: investment, research, and development. Again, look at it. The same sectors, technology and communication. In any type of metrics and indicators, like capital expenditure, like cash, like valuation of the price earning ratio, or like the valuation of price to book ratio. Communication and technology services saying that you can bring your money in these sectors. And now, Europe, not the United States, and other cases, it is performance drivers. What is triggering the performance of the company in the financial market, in the euro? And please look at this average discount premium since 1997 and the current discount premium. As you see, current is really, really lower. What does this mean? Europe is absolutely cheaper normally. Why? Because Europe has a structural problem in their monetary policy, and how can I say, not just the monetary policy, but their conversion transformation of the lifetime, technology, infrastructure, etc. Not just in the one thing, but the Europe has lots of problems in absolutely in even the age of the retired, even the infrastructure, even the transformation of the technology. Maybe some of you heard about the Draghi reports, which is pressed approximately 3 to 5 days ago, Draghi report. And Draghi report basically saying that lots of startups, technology firms, and lots of infrastructures moving from Europe to the United States because of the huge regulation. the structural problems has huge turmoil and drawbacks in the Europe compared to the United States. And the buyback and dividend yield in the Europe region, it is saying about buyback by the mean, if a company price really dropping in the financial market, it is cheaper, company can declare a buyback program, meaning that they are buying their own shares in the market. And the dividend yield, meaning that you are a shareholder in the company, and at the end of the year, from the profit, according to percentage of shareholding, you are getting a net income. This is dividend yield for you. And here, as you see, dividend yield is higher in the United Kingdom, 4%. The lowest in the United States is around 1.5%. And the net buyback here, again, higher in the United Kingdom and even negative in the emerging markets. And now, global fixed income yields and the duration. What we mean by fixed income? Fixed income is riskless asset in the financial market, meaning that like 10-year treasury bond, like 30-year treasury bond, government bonds and treasury bill and government bonds in the financial market called as fixed income. So these are the developed market government bonds, Japan, Germany, and the United States, 10-year treasury yield. These are the investment grade bonds all over the world, high yield bonds, a little risky, and Asia emerging market bonds, here as you see. And the bond prices will rise because the interest rate decreasing in the financial market in next couple of months. For that reason, if you buy the bonds today in any market, the interest rate will decrease and the price on bond will increase in the financial market. So you can put some percentage of your money in the fixed income if you are a risk averse person as well, to hedge your position in the financial market for any type of volatility. And here, global fixed income, as you see, US high yield, investment grade, Europe high yield, investment grade, China offshore, Asia high yield. Look at the Asia high yield. Huge basis point, 1,600. So if you are taking position in the high yield bonds, yes, you can have an opportunity to get huge return, but the volatility is higher as well. So you can lose the money there as well. And the policy rate cycles and market performance. So please look at, by the way, I want to show this one because we are almost reaching our time bound and I want to answer your question as well, but please focus on this chart. This is VIX index. VIX is Chicago Board Option Volatility Index. It is called as fear index in the world. If this VIX index is increasing, stock price is decreasing, risk is increasing, you can call this VIX as risk. If it is increasing, risk is high. Global financial crisis here. COVID-19 crisis here. .com crisis here. Gold crisis here. Everything which is triggering the reaction and risk in the market. Please look at this one. 19 right. Oil price shock. 1997, Asian crisis in the currency. Or let's say, here as you see, Enron account scandal or .com crisis in the recession in the 2001. Global financial crisis, Greece, Europe, Chinese yuan devaluation. And here as you see, coronavirus pandemic and Russian crisis. So if the VIX is increasing in the market, you can use this type of, by the way, the average for approximately, let's say 30 years. For the VIX is 19. So if you are an investor in the financial market, and if you want to hedge your position in the financial market for any type of risk, please use this VIX indicator as an early warning system for you. And if it is increased above the average line, please increase your cash position and decrease your risk asset position like equity, like crypto, like any type of risk asset and risky investment. If the VIX is increasing, above the average line, please decrease your equity or risky position in the market and increase your cash position in the market. This is the end of my slides for today.